Hello everyone, this is Dave Allison with Alison Wealth Management. Just wanted to take you through a quick Q1 market review. It's been a pretty wild first quarter to 2018, specifically with the volatility we're seeing in the market right now. So in this quarterly market review, which you can download from our website, we just want to go over a market summary, some of the different asset classes around the world and how the performance has been, and a little bit on the impact of diversification. And a quarterly topic is sailing with the tides. So first off, just a quick summary, the highest level view that we have. You can see we have some red arrows going down, which we certainly haven't seen in a while. We're still sitting on the brink of one of the largest bull market runs since the crisis in 2008, but now we're starting to see a little bit of red numbers. If you look in the U.S. stock market in Q1, it was down about 64 basis points or 0.64%. If you look at the average quarterly return since 2001, we've seen an average return of about 1.9%. That even includes the tech bubble that burst in the early 2000s and the 2008 downturn that we saw. You can see it's always interesting to see the best and the worst quarters. The best quarter we saw was during the recovery after the 2008 crash, which was up about 16.8% in one quarter. And of course, the worst quarter we saw was Q4 2008, losing about 22.8%. So down 64 basis points, not too far off the quarterly average of 1.9 positive that we see. And certainly we see more positives than negatives over the long haul, and that's why markets work over the long haul when you have a longer investment time horizon. On the international developed space, we saw a little bit bigger dump in the market, down about 2.04%. Averages of about 1.5 that we've seen over the last 16, 17 years there. And you can see the best and the worst not too far off the U.S. market. Emerging markets was one of the few that actually posted a green. We're still seeing a lot of growth opportunities in emerging markets, up about 1.42%, where the average quarterly return we've seen is about 3.2. So definitely a lot of risk and reward opportunities in the emerging market space. And then global real estate probably had the biggest hit, most of it driven by the United States. We saw about 5.79% loss on the global real estate market, where we've seen quarterly average returns of about 2.5%. On the fixed income side, U.S. bond market fell down about 1.46%. We've been talking a lot about the inverse relationship between interest rates and bond values, and it's one of those kind of finance 101 is interest rates rise, the principal value of bonds fall, which is why we've been moving a lot of client assets out of individual bonds or bond funds. And if we are using bonds, it's generally very short duration, high quality fixed income that is not going to have a lot of interest rate sensitivity. So we've been able to help diversify and offset some of that interest rate risk in bonds. The global bond market was up a little bit. If you look at the global bond market and exclude United States bonds, it's up about 94 basis points for Q1. Now, we know it's been a rocky start to Q2 already. We've seen some of the big tech companies get slammed pretty hard. Leading the way was Facebook, obviously, with a lot of the news that they had and losing some of their market capitalization. But we're seeing a lot of volatility right now. If you've turned on the media, you've probably seen we have big swings upward, big swings downward, and we'll talk a little bit more about that. If we look at some of the key headlines in the first quarter, you can see we started off the quarter with the tech giants roaring, again continuing to fuel a lot of the growth in the overall stock market. The NASDAQ crested at over 7,000 to start off, and then we got to this new tariff and potentially trade war into February when Trump imposed some tariffs on China. That started to kick off some retaliation. We saw a slight pullback. And then a bunch of other headlines throughout the course of the quarter. Home sales posted their sharpest drop in 3 years. We saw the dollar drop to the lowest level since December of 2004. Dow Industrials plunge into correction territory. People started to say, if you look at the bottom of that February downturn, but then as you can see, we started to see it go back up and down again and kind of do what the stock market does in short-term time horizons, certainly goes up and down. We still feel like the market is very well priced right now with all news and information in the individual stocks that this World Stock Market Index holds. If we expand out, again, you can see the last 12 months, even though we've certainly seen a lot of short-term volatility, over the last 12 months, we're still showing positive growth. The world stock market started the last 12 months, March of 17, at about 210, and it's still hovering right around 240. So even with all this news, and you can see the Fed raised rates, and we started to see a little bit of pullback towards the end of the quarter. We still are at positive territory for the trailing 12 months. Going back even further, if you look in that small white box, you can see long-term growth, which is really how we measure the market. If you think about the financial plans that we put in place with the bucket plan, making sure you have your now bucket, which is your safe and liquid money, your soon bucket, which is your more conservative money, gives us a long-term time horizon to confidently invest the rest for growth. And you can see if you had invested back in 2000 and currently where we're at, definitely in a much better place, even though we did experience 2 corrections during that time period. So if we look at world asset classes, you can see, as I mentioned earlier, emerging markets still leading the way in terms of performance for the first quarter. And just a quick highlight, some of the other asset classes that you can see. The Russell 2000 index is small company stocks, where we tend to overweight the portfolio. You can see it was one of the better asset classes for the quarter, even though it still produced a small negative loss. Russell 3000 are all the stocks in the United States marketplace. The Russell 1000 are the 1,000 largest stocks in the United States. The S&P 500 are the 500 largest growth stocks in the United States. And so you can see some of the different various asset classes. And down at the bottom, the United States real estate market space lost about 7.5%. Definitely the worst performer of the quarter. In terms of U.S. stocks, small growth led the way with a positive return of about 2.3%, followed by large growth stocks at about 1.42%. Large value stocks, finished up at the bottom at about 2.8% loss. In the international space, again, small cap led the way, followed by growth, large cap, and then value. And so in terms of US dollars, this is how the performance shaked out. And international developed space makes up about 36% of the world stock market. On the emerging market space, which again led the overall performance for the quarter, value led the way, followed by large cap, then growth, then small companies. And this represents about 12% of the world stock market. In terms of country performance, you can see Finland, Italy, Singapore led the way. Down at the bottom, the biggest losers were Canada, Australia, and Switzerland. You can see the United States was right there in the middle. So in terms of overall worldwide growth, the United States was right in the middle of the pack. And then emerging markets is over on the right-hand side, led by Egypt, Brazil, Peru, and Russia. Down at the bottom, the Philippines, Poland, India, and Indonesia were some of the bigger losers for the quarter. Currency, the Japanese yen led the way in terms of appreciation against the US dollar. You can see the Canadian dollar was the biggest loser for the quarter, so if you're planning that Canadian vacation, now might be a good time to go. Real estate, we mentioned, was the biggest loser for the first quarter. You can see the global REIT market space, which excludes the United States, was only down about 1.26%, but in the United States, the real estate investment trust market space was down about 7.5%. Fixed income, we spoke about this earlier, but the 10-year Treasury began to rise by about 34 basis points. So we're starting to see interest rates rise, which could have an impact on bond values. So it's something we've been keeping an eye on for a number of years. I don't think it's any secret that the Fed has intend to continue to raise interest rates. And so you can see what those bond yields are across the board. The 10-year U.S. Treasury is about 2.74. Corporates, highly rated corporates are at about 3.32, and lower rated corporate like junk bonds are at about 3.88% in terms of yield. So again, something that we measure what the risk and opportunity cost is to go into equities, really by what some of the risk-free rates are on longer maturity fixed income like the 10-year Treasury at 2.74%. I love this last slide because it shows what we do day in and day out and the impact of diversification. You can see on the top right corner, if you were invested in a 100% stock portfolio in the first quarter of 2018, a diversified stock portfolio, you'd probably be down about 1%. But as we blend in fixed income to help offset volatility, you can see in a 75% stock, 25% bond portfolio, you'd only be down about 50 basis points. In a 50-50 balanced portfolio, you'd only be down about 19 basis points, which is why we use that 50-50 balanced for the soon bucket as a conservative allocation. The 25-75 was actually in positive territory for the first quarter, even though the market was down. Again, another place that we use that soon bucket money for. And if you were in 100% treasuries, obviously you'd post a positive return of about 34 basis points for the quarter. But if you look down at the bottom, you might say, well, why do we invest in stocks? And certainly stocks have the highest opportunity for growth over the long term. It's the basic relationship of risk and return. If you looked in 1988 and you invested $10,000, today, that $10,000 would be worth over $100,000 if it was in a 100% stock portfolio. It'd be worth around $60,000 to $80,000 if it was in a 75% stock, 25% bond portfolio. Be worth about $50,000 in a 50-50 portfolio, about $30,000 in a 25-75 portfolio, and about $20,000 if it was just in government treasury bills. So again, this shows the importance of diversification and how we blend your portfolio depending on if it's going to be soon bucket money or later bucket money, and the importance of segmenting those monies based on time horizon and purpose. So just to close out the first quarter of 2018, we have this article called Sailing with the Tides, and I just want to read you the first sentence. Embarking on a financial plan is like sailing around the world. The voyage won't always go to plan, and there will be rough seas, but the odds of reaching your destination increase greatly if you're prepared, flexible, patient, and well-advised. And this speaks to the bucket plan as the crux of the financial planning process. There's no doubt about it. We're going to continue to see more volatility in the stock market. Who knows what's going to happen with our current president in office and this trade war impending, plus all the privacy and data issues we're seeing and the scrutiny around more government regulation of the tech companies. But no doubt about it, over the long haul and the later bucket, stocks and equities continue to validate the higher potential for long-term growth, but it's also equally important to have a properly funded soon bucket with the right amount of money in a more conservative allocation, depending on what the time horizon and the purpose of your money is. So if you have any questions, please let us know. We certainly appreciate you being a valued client of Alison Wealth Management, and you can go ahead and download this market recap from our website if you want to dive into any of the data any further. Thanks a lot, and I'll look forward to catching up with you at our next annual review or through the Q2 market update.